Hey, this is J.R. St. Julien with the St. Julien Real Estate Group of EXP Realty, and welcome to my San Diego housing market update for March 2024. Stay tuned. Hey, the spring market is officially here. I know it might be hard to tell if you look outside at the weather, but it's officially spring, and the market is showing itself to be a traditional springtime market. Traditionally, the San Diego housing market ebbs and flows as we go through the different seasons. And in the month of March, we enter into the spring season. And as we enter in the spring season, the market starts to increase with a combination of more inventory and more demand. As we get into the summertime, we peak in the summertime and then we start to settle down for the holiday and fall season. So we are definitely in that spring season. But before we get into all the specifics about the San Diego housing market update, I want to talk about the macro level things that are affecting our market as well as many other markets across the country. So inflation, that's been a topic for the last couple of years and it's still the topic today. Now, that being said, inflation is doing what we want it to do. It is being sticky, though, as we get to the kind of final leg of this inflation journey, trying to get back down to that 2% core CPI inflation number that the Fed is looking for. It's taking a little bit longer for us to get there than some may have expected. But as I mentioned in my previous market update, the Fed is projecting that we probably won't start cutting interest rates till the end of the year or further down the year. And at the last Fed meeting, they kind of echoed, hey, we're thinking about 3 interest rate cuts this year. We're not quite sure when they're going to start, but we're not doing them this time around. So at the last meeting, they held interest rates steady because inflation, while it continued to come down, where core CPI inflation dropped from 3.9% over a 12-year period in January to 3.8% over a 12-year period in February. And that's the core CPI inflation, where they take out the volatile things like energy and food. Now, if you look at the total CPI, where they're looking at pretty much everything, we went from 3.1% in January to 3.2% in February. So you can see those numbers, one went up, one went down, and changing very minimally. So inflation continues to be sticky. Now, it looks like everything is still moving in the same direction. So the Fed's still on the same course to potentially cut interest rates later this year, which should then trickle down to our mortgage interest rate. Right now, the 10-year Treasury bond, which is the most reactive to the Fed interest rate cuts, which is what our mortgage interest rates are typically tied to, that 10-year Treasury bond has been fairly steady over the last month or so. So we haven't seen interest rates move that much in the mortgage market either. We've been kind of ping-ponging around a little bit, but not drastically, but we've been definitely in the 6%, sometimes low 6s, sometimes high 6s, but we've been in that 6% range fairly consistently since January of this year. So interest rates have kind of found some steadiness, and I think the moves going forward will be slow as the Fed starts to make their cuts, which probably will come later this year. So that's what's happening at the macro level. So now let's talk about how that's affecting the local market. Well, I can definitely tell you, obviously, like I mentioned, spring is here. So that means we're seeing 2 things happen right now. We're seeing inventory increase and we're seeing demand increase slightly. One thing we are additionally seeing along with those 2 trends is that there's starting to be a little bit of a separation between what's happening with detached homes and what's happening with attached homes or townhomes, condos, which I believe is directly a result of the difference in the cost between the 2. Obviously, detached homes cost more, townhomes, condos cost less due to the high cost of everything in San Diego. We're starting to see more demand and activity in the attached condo space, and it's starting to create a little bit of a difference in the stats that we're getting for those 2 numbers. Usually the stats aren't drastically different, so they're not worth reporting independently. But this time, we're definitely starting to see some differences, and we'll find out here in the next few months whether or not this is a new trend. But I definitely think it's directly related to the cost of homes in general in San Diego, because obviously everything is expensive. So let's get into the numbers. Inventory is up 6.1% year over year. But I want to give you a reference point that's not just last year. If I go back to this month in 2022, inventory is down 22%. Now, as I mentioned, there is starting to be a little bit of a difference between attached and detached homes. The inventory for detached homes decreased 11.5% year over year, and the inventory for attached homes increased 20.5% year over year, which means that we have less inventory of single family or detached homes, more inventory of attached homes on the market. It's kind of an interesting little tidbit of information. Okay, so now let's talk about demand. Pending home sales increased 1.5% year over year. Now again, I want to give you a reference point back in 2022. That's down 29% since this time in 2022. So this March of 2022 is down 29%. So we're up, but if you reference it back to what was happening 2 years ago, we still are drastically down in the number of pending home sales, which is basically showing the demand of what's happening in the current market. So inventory referenced 2 years ago is down, but it's up year over year. Pending home sales is down when you reference it 2 years ago, but it's up year over year slightly. Now again, there's a slight difference between detached pending home sales and attached pending home sales. Detached pending home sales is up 1% year over year, and attached pending home sales is up 2.5% year over year. So you can see there's a slightly higher level of demand for those attached sales, and there's also a much higher level of inventory for those attached homes. Now, this is what I'm talking about when I'm talking about we're hitting the spring market. So yes, we're getting a little bit of uptick in inventory. We're getting a little bit of uptick in demand, but we had a 6% price appreciation from January to February. Now, right now it's March, but all the stats that I'm giving you are coming from the month of February because that's the data that we have in the month of March. We can only kind of see what's happening after the month has passed. But 6% in 1 month. Now, year over year, we're up 14.3%. Now, if you break that down for detached homes and attached homes, detached homes, single family homes are up 16.1% year over year, and attached homes are up 7% year over year. So again, there's a differential there. And you can see the single family, the attached homes, they're getting a little bit more appreciation, but we're starting to see a little bit more demand for the attached homes, the condos and townhomes. And my assumption, just based on my experience with the market, is that's all around the price. Because as those attached homes have appreciated as much as they have over the last year, 16%, they are pricing out many people that want to buy a home, and they have to settle for a townhome or a condo when they really wanted a single family home, but based on the prices, this is what they can afford. So how is all this information affecting you if you're thinking about buying or selling a home? Well, one thing I can tell you, if you're sitting on the sidelines waiting for the interest rates to change before you buy a home, that should not be a reason why you're sitting on the sidelines. And this is why. The Fed is saying that they're going to do 3 25-point basis cuts this year, and they're projecting 3 25-point basis cuts next year. That's basically 0.75% or 0.75% in cuts. So if we do a 1-to-1, which is not necessarily going to be the case, it being 1-to-1 from Fed cuts to mortgage rates, but let's just say it is. That means the rate will drop 0.75%. I've seen the rate drop 0.75% inside of a month because it's ping ponging. And while you're sitting on the sidelines waiting for the rate to drop, the prices of the homes are increasing. As I mentioned, in 1 month, we saw a 6% increase. That's equivalent on a traditional mortgage to a 0.5% interest rate hike. The difference in the monthly payment that you would have to make on a home that costs 6% more is equivalent to a 0.5% rate hike. So while you're sitting on the sidelines waiting for some trickle down interest rate cuts, while the prices are going up, you're allowing the prices to outperform or beat out any potential interest rate cuts that may come. And if the prices are appreciating month over month like it did this past month with a 6% number, what do you think is going to happen when the interest rates actually do come down below 6%? Buyer demand is going to ratchet up and prices are going to follow suit. So if you're sitting on the sidelines because I'm waiting for interest rates to come down, that's a horrible reason to be sitting on the sidelines. Now, if you're sitting on the sidelines because you're saying, hey, I can't afford it based on the interest rates, that's a different story. If you can't afford it, you should not do it. But if you can afford it and you can find a home that matches your necessary criteria, and you may have to give up some of the things that you want, but if it meets your needs, you should do it, and you should do it now, because prices are only continuing to appreciate, and at some point in the future, interest rates will come down. And once you have the home, you can change the rate on that home if the interest rates come down to the point that makes it sensible to do so. So if you could afford the home with the current rates today, you should not be sitting on the sidelines. That's a foolish move, and I'm seeing a bunch of people that made that decision get priced out of the market due to appreciation and the home values going up, that now they can no longer afford to buy anything, which is unfortunate, and that's sad, because as you have heard me say time and time again, the net worth of homeowners is 45 times, not 45%, 45 times that of the net worth of renters. And this is a market where if you can afford to own a home, you want to own a home because it will pay you to own that home over a long-term period. Now that was for the folks that are thinking about purchasing a home. Now, if you're thinking about selling a home, again, it's a great time to sell because inventory is still low and demand is still more than the inventory. We need the supply. We need your home to serve those that are looking to buy a home right now. So if you're thinking about selling, it's a great time to sell. We're just into the spring market. There's no better time to sell than now. So if that's something you're thinking about, or if you're thinking about purchasing a home, I'm here. I love to talk real estate. I would love to chat with you about your personal situation and what we can do to help you achieve your real estate goals. So I'm JR St. Julien with the St. Julien Real Estate Group of EXP Realty. This is my San Diego housing market update for March 2024. Take care.